they were primarily a cable manufacturing company, right? Did it make sense to get into it? What was that play?
I mean, they've been the pioneers of that move. The first move was from cables to switchgear, high voltage switches, capacitors, MCBs. The next step for them was to get into small, say, lighting and fixtures. So they started making lamps, ceiling lights, table lights, ceiling fans. And the big move came somewhere in FY18 where they acquired Lloyd and got into consumer electronics overall, which is larger consumer electronics like your ACs, TVs, fridges, and washing machines. Why I think it makes sense is because everyone else is kind of following now.
This episode of Taking Stock is brought to you by Paterson.
Welcome to Taking Stock by Paterson, where we cover a stock every week and we do a deep dive on it. Today we're going to be talking about a stock that has been giving a lot of people the chills, and it has been inciting our researchers' deepest cliche-doling instincts. So he's used phrases like electrifying moves, he's used phrases like lights are temporary out, flip the switch on, etc., etc. Sagar, tell us what the stock is about and then let's get into it.
So the stock, very off topic. In the winter of Bangalore, we're talking about air conditioners.
Yeah.
The stock is Havells.
Right.
And we're going to start talking a little about the AC business.
Yeah, the whole landscape.
Because generally, while India has seen very hot summers, last year was a little bit of an anomaly in terms of the summer just ending early and monsoon starting earlier, which ended up impacting a lot of AC manufacturers. Whether it is end sellers of ACs or component manufacturers, everybody in the entire value chain got impacted by the subdued AC sales. And obviously Havells was one of them. For a lot of people who don't know, Havells also owns a brand called Lloyd,
Right.
Which is into consumer electronics. And the largest product within Lloyd is room air conditioners,
Right.
which is also great and surprising, right? For a
Correct.
old wire and cable business, 70-year-old company getting into electronics now, which we'll also be talking about further down. But interestingly, coming back to ACs, I think 2-3 things happened. One is generally the summer being truncated this time around, which led to a lot of unsold ACs. So these guys usually, there is a lot of seasonality in the business in terms of 1Q, 2Q being very heavy in terms of sales. Because summer is when people buy ACs. They don't really end up buying during the winters for the summer.
Correct.
And because the summer was truncated, people didn't end up buying ACs. Their forecasts went wrong and they're sitting on tons of inventory, which is unsold. So revenue declined, inventory was unsold. On top of that, the government said GST is going to get cut, or there were murmurs of that happening through the year.
Right.
And because of that, people sort of delayed their buying also. So they were like, hey, let me not buy it right now. If I'm getting a 18%, 20%, whatever amount of discount later during the year, they'll just hold off purchases, which led to further problems for these guys. And the last bit was that there are new energy efficiency rules coming out as well. If you notice, every AC, even fridges, have that star rating.
Correct.
And that star rating is something which is dependent on how efficiently a certain electronic is using electricity. And these electricity norms are on a continuous basis improved by the government or by whichever agency is controlling it. In this case is the BEE. And now they're talking about standards so they're typically saying that Indian standards are very low at this point in time. And there is a massive upgrade that is expected to come in, which will be to such an extent that companies will have to improve their energy efficiency by as much as 50%, which will also result in the fact that all the ACs that are currently 5-star will become 1-star rated. But that is not going to be an immediate move. That is expected to kick in sometime by 2027. Right. However, what kicked in this year, starting 1st Jan 2026, was that one rating downgrade happened. So all the 5-star ACs basically became 4-star ACs. What this essentially does for AC manufacturers is that they have to now get rid of their existing inventory before the new norms kick in, or in a certain window that the government allows to say that, hey, this is a window where you can still sell. But beyond that, your packaging has to change. It has to match what your current AC is, etc., etc. So all of these things together have resulted in a point where for 3 quarters straight, revenues for AC companies have sort of declined on a YOY basis. So even if we look at the numbers for a Lloyd, the first quarter of FY26, they saw a decline of 34% year on year. Second quarter, 18% decline. Third quarter results came out just about a couple of weeks back. The decline was 6%. So the situation is improving. But however, if you look at the overall year, they're still going to end up in a negative when it comes to revenue growth. And for Havells, Lloyd makes up for about a quarter of their business. And AC is a majority portion within Lloyd. So the overall impact has been pretty significant when you look at, imagine a quarter of your revenues declining by a third in a single quarter. So that's pretty massive when it comes to the overall impact.
But what were they? So they were primarily a cable manufacturing company, right? Or or with cables and adjacencies. So overall, did it make sense to get into it? What was that play? So the acquisition itself. And
interestingly, it's one of the very few companies. They've been the pioneers of that move. So cables and wires, there are multiple companies. There is KEI, Polycab. These guys. There are large players in that market. The first move was from cables to switchgear. And we're not only talking about domestic switchgear, which is your basic modular switches, but also at an industrial level, because then these get more complex. Because there is variation in terms of energy levels, voltage, high voltage switches. So there are capacitors, there are MCBs, there is a lot of stuff and technicalities that go into switches, and not just the functionality of tap in, tap out.
right.
So they got into industrial switchgear and domestic switchgear after that. The next step for them was to get into small, say, lighting and fixtures. So they started making lamps, they started making ceiling lights, table lights, ceiling fans. Then they moved into smaller electronic appliances like water heaters,
Right.
Personal grooming,
Right.
kitchen appliances, stuff like that.
Right.
And the big move came somewhere in FY18 where they acquired Lloyd. And got into consumer electronics overall, which is larger consumer electronics like your ACs, TVs, fridges, and washing machines. Does it make sense? Maybe, maybe not. They were one of the first, not one of the, they were the first ones in the cable and wire space to do that. Why I think it makes sense is because everyone else is kind of following now. Why are they following? Because from a backward forward integration, primarily this is forward integration.
Correct. It is.
This is not really backward. This is
Correct.
going forward.
Correct.
So they are forward integrating, which is a pretty legitimate, good business strategy for any company to follow.
Explain the forward integration for our viewers. How will sort of a cable and a switchgear and small device kind of thing move in the context of the acquisition?
So electricals, so there is something known as electricals, which are your cables, wires,
Correct.
very basic pieces, circuits that these guys used to make.
Correct.
One step above is to make electronics. So from electricals to electronics, you require more capacity and capability, because now you're assembling several parts together. So that is like a step up. Now they have to do that in both mechanical terms and electrical terms. Sorry, and component terms as well, because now you need a casing for the overall device as well.
Right.
So it is a step up in terms of what they were doing earlier. And then from small appliances, they move on to larger appliances. So, I mean, actually backward integration is easier to explain, because then you have the end product and then you can imagine that you want to make every single part of it.
Yeah.
So this is sort of going the other way, where they used to make the base parts of it and now they're trying to make the entire product. It also makes sense from the perspective that Havells was also the first one in India to be able to advertise switches. this was back in the 90s, the Shock Laga ad campaign, which was very, very popular at that point in time. And nobody was advertising switches.
Right.
Nobody was advertising MCBs.
Right.
People didn't know what MCBs were.
Right.
And these guys were one of the first ones to sort of build a consumer-facing brand.
Right.
And that worked for them.
Right.
So why it makes sense is also because they were able to market a typically B2B or a non-branded consumer product.
Correct.
Give it a brand. Correct. And actually make it work. Correct. Because they were the market leaders when it came to switches, whether it is this or whether it is Crabtree. All of that aggression towards ad spend and marketing they were able to do.
Correct.
So once I think the company realized that it is in their DNA to be able to be consumer facing, right, and not a lot of companies are able to do that.
Right.
I think they just took advantage of it.
Right.
So like, if we are able to face consumers, why not go all the way and start introducing electronics?
Right.
So that was, I think, the second reason why it makes sense.
Right.
The last reason why I think it makes sense is that their overall strategy, which is a very interesting infographic they have in their annual reports and presentations as well, is they put a picture of a home. And they say that they were inside the home in terms of just behind the wall. Now they're getting in front of the wall, and from the front of the wall they're sort of capturing the entire home. So from that perspective it makes sense. If your market is the home, then you might as well cover everything in it.
Right.
So from that angle also it sort of does make a lot of sense for Havells to do that.
Right. Right. The acquisition, how is it sort of playing out? You've talked about why it made sense to do it, but some of these things, not always sort of pan out the way they should, right? So how is the acquisition itself generally panning out?
Interestingly, they acquired this company in FY18. One of the things that didn't sit quite well during that time was that if you are building Havells as a brand, and you're saying that all of those things of getting from behind the wall to front of the wall, etc., then why acquire a different brand altogether, which is Lloyd? Because you're going to spend up more money promoting that brand, building that brand, creating, and it's not an easy job to create a brand. Organically, it takes a lot of effort to just get it visible, especially at a nationwide level. However, they did that. FY18 to 25, their revenue has grown 3x. So 6 years, 3x revenue, not bad at all when it comes to scale. So they're at about 5,100 crore as of FY25 in terms of revenue in Lloyd. So from a scaling perspective, it has worked. They have been able to achieve this, however, through 2-3 things. One of them being steep discount for customers, because the proposition was pricing. As a new player in the market, they were trying to position as a mid to premium player. LG is the premium one in India. Mid to premium, you've got Voltas, Blue Star, etc. And price range. So the positioning these guys are trying to do is along with the Voltas, Blue Star, but the price point is lower. So steep discounts and very heavy aggression towards distributors. So they're doling out a lot of incentives in terms of commissions to distributors, going very aggressively in terms of increasing the distribution network as well. They've almost doubled it in the last 3 years to about 20,000 distributors now. Distributors or dealers, how I want to say it. That's the second part. And the third part is advertising. So even if you look at last year, they did an IPL campaign, spent about overall 610 crore on advertising only in the last 1 year.
This is on the Havells brand?
Altogether,
both.
Havells plus Lloyd. So they've ended up spending massively in terms of advertising and marketing as well, which the other players are not yet doing that aggressively. So using all these 3 things, they've been able to scale up pretty significantly. However, that has come with a lot of hiccups and roadblocks. If I look at the operating margin, they're doing about 3% operating margin at this point in time, Lloyd. And this compared to when they acquired it, it was 17%.
Wow.
The other players in the industry do about high single digits. LG, Blue Star, Voltas, everyone is between say 8-9-ish%. So these guys are still very subpar when it comes to margins. Now, if we look at the strategy to attack the market, it was spend on ads and marketing. That resulted in lower margins.
Correct.
But also what has resulted in lower margin is the fact that these guys have faced several issues since the very inception. Beginning, they started targeting the TV market. They started building a product pipeline for the TV market. They built up the product. They tried to sell it, but then there was a flood of Chinese goods coming in. So duties were changed by the government. Chinese goods started getting dumped into India. You had new brands come up in India, and these guys didn't really make the mark. So they had to discontinue their TV operation, or at least not discontinue, scale it down. And then they had a renewed focus on the AC market. And now that they're trying to build the brand, the profitability is not yet coming in. And with the AC market, there is a high amount of seasonality, which we've seen in FY25.
Right.
So every single year since they've acquired, although they've been able to scale, there are some issues which have been creating a hindrance on the profitability. So profit margins are still very subpar. They have the potential to move towards peers like peers at about 7-8%, but still very, very subpar. So overall, I think good acquisition, but has it yielded much in terms of return ratios or profitability? Not really. Has it sort of even given the money back, because the free cash flow should ideally pay back what they acquired it for, which is 1700 crore. Not really. That's not happened as well. Additionally, they've had to spend a lot of money in terms of product R&D as well, because again, they've launched a wide array of products. They've recently gotten into washing machines and fridges as well, which again is not very simple to launch. You have to do the R&D, design work. Manufacturing mostly is in-house, stuff like that. So that's again costing them margins.
But how is their traditional business doing? The whole cables and switchgear, is that?
That is beautiful. That is, so if I have to just break the revenue down, switchgears is about 11% of revenue as we speak. Cables is 33%. So cables and switches together is about 44%. Then they've got lighting and fixtures, which is your lights and fans. That's about 8% of revenue. Electrical consumer durables in the brand of Havells, which is water heaters, grooming devices, kitchen appliances, is about 20%. Lloyd is about 24%. And then there is a small other segment which does motors, solar modules, pumps, EV batteries, blah, 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 which is 6%. So if I have to again broadly split it out, 44% is cables and switches, about 19-24. So that will be 45% will be electronics. And about 14% is your smaller items. So that's the broad revenue split. Cables and switchgears is as an industry growing very, very fast. So you're in a place where, because of high infra spend, because of housing demand overall being very strong, and because of overall industrial demand also being very strong, cables and wires are growing in double digits for everybody. So irrespective of whether it is Havells or Polycab or KEI, I think the entire industry is seeing phenomenal growth when it comes to cables and wires, which is also a better profitability business for these guys. So if I just have to look at the profit split as well, switchgears is 11% of revenue, but contributes to 25% of the profit. Cables is 33% of revenue, but contributes to 36% of profit. The problem is Lloyd, which is 24% of revenue, but only 6% of profit. So, yeah, it's a traditional business is great.
Is cable and switchgear a little more a B2B business, or is it largely still a B2C business?
Both. So they have B2B as well as B2C. And in several products, the market share also differs, because if I sort of again look at switchgears, they have about a 20+% market share in MCBs, about a 12% market share in modular switches. But their wires and cables business, they've got about 10 to 15% market share. But these are also much larger addressable markets. So overall, I think they're in a place where market share is good. The overall industry is also large enough, and it is a mixture of B2B and B2C. But the demand driver or the steady demand is coming more from B2B than B2C, because these are all industrial applications that we're looking at and bulk buying. Even in B2C, I mean, it will be B2B2C.
Correct.
Because when it comes to, say, putting it in your home, you're not the one directly making the choice. Your interior decorators making the choice, or your contractors making the choice.
Correct.
So it ends up becoming B2B2C.
So the whole thing of building the brand is sort of obviously taking its toll on them, right? The post Lloyd,
Yeah.
because you're talking of it in the context of one marketing spends, which are significant, and then there are also new products that are coming in as part of the wider array of what they want to place in front of the customer, right?
Yeah.
I think some of that is sort of okay.
So overall, if you look at the market, and from a long-term perspective, there may be a little bit of a cyclical bump that is, or a temporary bump that has been not temporary also because it's happening for 2-3 years in the cables and switches market. But if I have to look at the overall electricals market, it is about 1,25,000 crore, the overall market size. That is expected to grow at a 10% CAGR over the next 5 years and reach about 2 lakh crore. The electronics market is at a 1 lakh crore right now, but it's expected to see a 12 to 14% CAGR growth, going up to 1,75,000 crore. So it is a higher growth market for sure.
Right.
Because a lot of the products that you see, especially ACs.
Right.
So if I have to look at India as a country, the TV penetration is the highest at this point in time.
Right.
Almost everybody, 60% plus is the TV penetration number.
Right.
Refrigerators are second at about 30%.
Right.
Because it being a hot country and us not really, us sort of consuming food and it not getting spoiled, etc., that proportion is at 30%.
Right.
Washing machines is at 10%.
Right.
We still do a lot of our washing at home with our hands. Not me. ACs is about 7%.
Right.
So that's where the highest growth also is. So they've captured or positioned themselves in the highest growing market.
Right.
And we sort of go back to the same problem where scale is coming,
right,
revenue is coming in, but profitability is not really coming in.
Right.
But I think at the same point, they're still better off compared to a lot of other players, because now what we see is that everybody is sort of getting into or migrating or trying to build a presence, not just in electricals, but also in electronics.
Right. Right.
So even the smallest of the cables and wires players are getting very excited by the fact that they can be consumer facing, they can forward integrate. They have seen a sort of success story playing out with Havells. And usually that's what happens, right? The first mover is the guy who takes the beating as well. So this guy has been sort of writing the playbook for the others.
Yeah, they'll skip the learning and they'll get there.
Yeah.
Who else is doing it? Sorry, when you say others?
Everybody. All the cable players are in some form or the other launching electronics. Not at the scale of Havells in terms of fridges and washing machines or ACs, but at least the smaller appliances. So everybody is launching water heaters. You've got those kettles, basic appliances in the kitchen. Most of the players have already made moves towards getting into that, and that's also, I think, a virtue of the fact that at the end of it, if you look at wires and cables, it is commoditized.
Right.
What value are you adding when you're making a wire or a cable? It is just taking a copper wire, putting a film around it. I mean, I'm making it sound simple. It isn't that simple.
We don't intend to trivialize it, but that's the truth.
But it is a commoditized play.
Yeah.
And I think at every level, that commoditization will come under threat at some point or the other. As you've seen in paints in India, paints was a commoditized play as well. But it got a high multiple, even adhesives, got a high multiple only because there were dominant players which were growing very fast. The moment that gets threatened, people do realize that why am I giving a commoditized business such a high multiple? And those tend to shave off. So I think everybody is getting into that circle where they're saying that, hey, we want to be a specialized player. We want a brand, we want a value added product, and not be remaining in that very commoditized play.
So you probably already answered this in bits and pieces, but tell us what the sense is on the valuation part. How does one look at it, right?
See, for this company, if I look at the FY25 revenue, it was at about 22,000 crore overall, and a quarter of it is from Lloyd. Now, typically for a company like this, you should break it down into two parts and say that wires and cables get a certain multiple, and the electronics business should get a different multiple, because they're inherently very different in nature, including in terms of how they're growing. For simplicity, however, if you just had to project numbers, And you refer to a few broker estimates and whatever, they're expected to say grow at about 11% CAGR from FY25 to 28, with some amount of margin expansion, because Lloyd is one business where the margin has potential for increasing, which is dependent on both product maturity, product maturity, brand awareness or maturity in the brand getting known, and a little bit of operating leverage as well. So all these three things should ideally result in much better margin for Lloyd. So margins can go up from here, or technically should go up from here, and they have been sort of improving for Lloyd from a low of about -7% 2 years back. They've already come to a positive 3%.
Despite all this marketing spends.
Yeah.
So you're saying those will start to kick in now. And,
yeah. So that should further sort of increase going forward, because the effectiveness of that marketing spend is starting to show in the numbers. And they would not need to discount their products so much. They would not need to incentivize distributors so much. So all that is very front loaded in terms of expenses, which can start tapering off. So broker estimates typically peg EBITDA CAGR for the next 3 years at about 15%. Now, the valuation front, what is happening is all the cables and wires companies are trading at very premium valuations, given the fact that growth is also very high. So if growth has been in the 20s sort of percentages with healthy margins, these guys are all trading at a premium valuation compared to the growth they're delivering. So even Havells, if I look at, for a 15% CAGR in EBITDA over the next 3 years, their 1 year forward PE is at about 50 times, which is supremely high compared to the kind of growth that they're delivering. But valuations tend to stick around if, one, the growth is high, second, the visibility of that growth is high. This checks both those points, and hence that valuation is there. On average, the 1 year forward PE over the last 5-10 years has been about 54 times. So the stock is corrected a little bit. About 10% discount is what it's trading at this point in time. What I typically look at when it comes to the valuations is that ideally it should start getting a little bit of a premium compared to the past because of a higher mix of electronics, which I would say is a better business from a branding, value addition, stickiness, overall profitability as well, from a return ratio standpoint.
And it's a core B2C, right? Which means where the longer term play, you'll have stickiness of clients and customers.
And also expansion in addressable market, the amount of stuff you can introduce once your brand is there. You can just introduce one more product and it will work under the same brand umbrella. So there are obvious benefits to having this business in the long term. So overall, if we look at improving profitability and from a financial standpoint, better return ratios, valuation should go back or there is a case for higher valuations to stick. But I think there are massive risks also in the business, because of which I wouldn't sort of go gung-ho on the current valuation, because it's only at a 10% discount compared to historical valuations. And those include, one is, as we spoke about, wires and cables is a commoditized play. And it's getting high valuations right now, but that may not continue in the future. There is no case for long-term sustainability of those valuations at this level. So as long as growth is continuing, great. But there's also talks of competition coming in there. So if Adani and the Birla Group have to enter this, and with them having captive production of copper, they are at a much larger advantage when it comes to wires and cables versus any other player, because these guys have to depend on copper manufacturers.
Genuine backward integration.
So they've been integrating forward, but backward for them would be acquiring a copper mine. Which is huge capex, which I don't think is on the cards for any of these guys. So they're going to depend on a Adani Kutch plant. They're going to depend on Vedanta. They're going to depend on all these guys for their copper procurement. And if again we're going into a place where Adani is going to control or the largest market share in terms of copper manufacturing is going to be Adani, then the price advantage is not going to be in the hands of these guys, especially if Adani enters the cables business and wires business, which they do intend to do. So that is a very large risk overhanging in front of them. The other bit would be that there are some short-term headwinds in terms of copper prices being very high, seasonality in room air conditioners, and that whole rating transition and all of that. But that is short term. But I think long term, I would just be very, very careful or wary of competition and wires and cables. So while there is a case for a re-rating, I think the base valuation itself has the potential of going down. And hence, although the story looks great, all the moves look
Right
look like
direction.
the right
Yeah.
direction,
Yeah.
and there is some amount of maturity happening in those moves.
Yeah.
The overall scenario itself doesn't, despite the growth, look very sustainable. Let's call it that. So we'd be a little more careful on those lines.
So there you go. Overall, a good story, but at current price and with the risks that surround it, there are potential for chills, which is what we what our analysts also said. Thank you for joining us. Join us again next Tuesday, but please do your research before you take any decisions. Bye-bye.
Disclaimer. This content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.